Hello everyone, this is Noel Vincent. I am the Managing Director here at Senior Partners Private Wealth Management. Good morning. Today is March 27th. It's Friday. It's about 11 a.m. Thank you for taking the time to watch this video. Our Director of Operations, Jeff Owens, and I have a number of important matters to discuss with you this morning related to the coronavirus. First, Jeff has a couple of quick matters to cover, and then I'll be back to talk about the economy. Jeff?
Good morning. As Noel said, I am Jeff Owens, Director of Operations. We know your time is valuable, so we'll get started. We're reaching out to you for three reasons today. First is to let you know that we are here for you. With social distancing and statewide lockdowns, our world has changed drastically, but financial services is among the nation's 16 essential infrastructure industries. We are exempt from work-at-home orders, curfews, and lockdowns. Our whole staff is ready and committed to take care of your needs. We will be here every market day for you as usual. Second, we want to give you our thoughts on the markets and the economy. This is something we give a lot of thought to here at Senior Partners and discuss routinely. We read economic reports, review research, and counsel with our colleagues at other firms. Noel will take a few minutes to speak to you about these matters. Noel?
Well, thank you, Jeff. Well, this is the fourth major market crash that I have seen in my 35-year career. In the first three, the market dropped by more than a third. 1987 to 1988. 1987 to 1988 was fairly short. The next one was longer, from 2000 to 2002. And then again from 2007 to 2009. In those last two, the market dropped by about half during those periods. Well, when this current decline began at the end of February, we identified it quickly as a downtrend. Now, the market moves up and down, the news can drive things, and we don't always want to jump out of the market every single time something negative happens or the market takes a dip. But we do want to try to identify downtrends. And a couple of weeks ago, going on 3 weeks now, we identified this current situation with the stock market as a downtrend and quickly advised our clients to start moving out of the stock market and moving into bonds. Now, I was new in the business in 1987, but advised steering clear of stocks in the 2000 to 2002 correction. That was called the tech bubble, you may recall. And then again from 2007 to 2009 when the credit and housing crisis happened. As many of you know, we got you out of the stock market during those. Now, I can't promise that we will always sidestep every single market correction, a correction being defined by a 10% decline from a previous high. Those can happen very rapidly, as we've seen in the last couple of weeks. But we do not believe that you should hold your portfolio in the stock market and ride it all the way down to the bottom in a crash. It takes too long to recover money from a market crash, and it's better to just avoid it altogether if you can. Yes, to make a return, it's very important to seek major gains, but it's equally important in making a return to avoid major losses. So getting out of the stock market, we believe, was a very good move for you, and we will be moving back into the stock market once we feel things have settled down and the coast is clear, if you will, and it's time to move back in. We will let you know. Now, I want to share some quick numbers with you from the S&P in the last few weeks. Now, since we advised exiting stocks more than a couple of weeks ago, the market still dropped another 12.4%, and it's down 28.38% for the year from January 1st through yesterday's open. The market, as I saw this morning, seems to be moving back down. I don't know where it will end for the day or for the week, but we are not bullish on the market. We are bearish on the market. We do not believe that, given this coronavirus situation and its economic impact around the world, that the market's going to suddenly recover and the economy is going to suddenly recover in the next few days or the next few weeks. We don't believe that can happen. The market peaked on the 19th of February, and it peaked at 3393, almost 3,400 on the S&P 500. That was an all-time record high for the United States. But then we found a low since that high on the 23rd of March. The market was down to 2191. Now, in a little over a month, the market dropped 1,200 points on the S&P 500. That's about 35% of the entire market's value wiped away in about a month. Year to date, through yesterday's open, the market was down 755 points on the S&P and 23.38% year to date, as I mentioned. Now, I keep referring to the S&P 500, and there's a reason for that. The Dow Jones Industrial Average only covers 30 stocks, and it only covers industrial stocks. The S&P 500 covers the largest 500 companies that are traded on the stock markets in the United States. The Dow 30 are included in the S&P 500. So obviously the S&P 500 gives us a much broader view of what's going on in the stock market day to day than the Dow Jones Industrial Average does. One last set of numbers. Since we exited the market and started giving advice on the 10th and 11th of March, where the market ended at 28.25, yesterday's open, it was at 24.75. That's a 350 point drop. And since we recommended clients exiting the market is down another 12.4%, as I mentioned. So these numbers are not very encouraging. I know that there was a market uptick the last couple of days, but it seems to be going back down again today. And we do not think we're anywhere near the bottom just yet. Now, in addition to the market news that we've been seeing, yesterday's unemployment numbers were very, very poor and very, very difficult to hear. Let me give you just a couple of numbers. Last week, 281,000 Americans lost their jobs and filed for unemployment benefits. 281,000. That's fairly normal. This week, the report came out, 3.3 million Americans lost their jobs and filed for unemployment benefits. That's an incredible number and an all-time new record high for the U.S. economy. It's unbelievable. So we think we may already be in a recession, and we're not alone. There are many financial advisors out there today, money managers, economists, that believe we may be entering a recession and that we in fact may already be in a recession, and we believe that's the case. Now, an official declaration of a recession would be 2 quarters, that's 6 months, 2 quarters back to back with negative economic growth. Now, economic growth is measured by the gross domestic product, the GDP. The gross domestic product is the sum total of all the finished goods and services that we produce in our economy for any given period of time. That's the GDP. Well, we don't think that we've seen the bottom of the market, as I mentioned, even with the recent uptick, but the economy, and I want you to really think about this, even if we get control of the coronavirus today, it's going to take a while for the economy to recover, for people to get jobs, for people to get back to work, for manufacturing companies to retool again and go back to making their own products instead of emergency healthcare products. It's going to take businesses reopening, restaurants being full of customers again, and people have to get back to work. So those things are going to take a while, and we have not seen any slowing down of the coronavirus's advance and spread. Right now, the numbers are still climbing. Even death rates, unfortunately, we're very sad to hear this, but death rates, of course, are still increasing day by day, and we do not have a handle on this coronavirus just yet. So it's going to take the coronavirus coming under control and then some time for the economy to recover thereafter. So in the meantime, unfortunately, we believe things are going to get worse before they get better economically in the U.S. Now, the third thing that we wanted to talk to you about was what exactly are we doing for you? What is Senior Partners doing for you? What is Noel, Jeff, Dax, Ann, Noah, Levon, Aaron, all of us, Ina, what are we doing for you? Well, first of all, we are and we continue to give you advice and guidance as economic conditions change. That's what we've always done, that's what we're doing, and that's what we will continue to do. That's what we do for you, is we give advice. Now, for the present, as I said, we are bearish on stocks. We do not think we should be in the stock market. We don't think anyone should be holding stocks right now, or if you do, very, very small percentage, 25% or less of your portfolio in stocks would be better than 100% or 50% or any number above 25. We are in touch with all of our clients that need action. If there's any activity in your account that needs to occur, we are reaching out to you, and you know that we've reached out to you, those of you who've had those circumstances. We're monitoring your investments every single day. We are talking to our investment sponsors. We are meeting over the internet with our money managers and sponsors, conducting due diligence, determining what decisions, if any, need to be made. We are also discussing how to prepare to get back into the stock market and how best to do that with the least amount of risk to you, with the best possible approach and return that we can get, because we do believe at some point that this market will turn around. The economy is going to turn around. The market will start to rise again. We'll be back bullish with a bullish viewpoint on the market, and we will want to see many of you get back into the market. So we're discussing how to approach that now. We're talking to our money managers and trying to determine the best way to do that for you. And once we have, we'll be reaching out to you with a suggested plan on how to go about that. Now, yesterday morning we had a teleconference with Vance Howard. Vance Howard is the president and chief money manager for Howard Capital Management. We had a great talk with him. The ALP growth money management model, which is one of many models offered by Howard Capital, is one that a number of our clients are investing in. We're very pleased with the performance of this program so far this year. As I said, at yesterday's open, the market was down about 23.4%. The ALP growth model that we use at Howard Capital, that's the separately managed account, was only down about 14%. The reason is that ALP has been systematically moving money out of the stock market and into bonds and cash, and they've been doing that for more than a month. They use an algorithm that triggers moving in and out of the market, and they've had a couple of triggers, and right now they are down to about 2/3 of the money in cash and about 1/3 in their mutual funds, and inside of those mutual funds actually stocks, but the rest cash and bonds. So when you do the math, about 74% of the ALP growth portfolio is out of the market. It's in bonds and cash, and only 26% is in the market, and that strategically in the market. So the portfolio is poised to re-enter the market once the algorithms trigger. All the money that we have moved out for you on the other side, where we are personally managing those trades for you every day, that money that is sitting in bonds and cash right now is millions and millions and millions of dollars. And that money is also poised to go back in the market. And as I mentioned, we're developing a plan to prepare you for that. Now, Jeff is going to speak about a couple of other important matters. He's going to talk to you about the tax season, required minimum distributions. There's some interesting changes there. He's going to talk about how we're handling office visits, and then I'll be back for a final word. Thank you. Jeff?
Thanks, Noel. Let's talk about this year's tax season. Tax season is well underway. Our tax manager, Aaron Keys, and his team are already preparing returns and available to meet with you by phone. If possible, please send us your documents by email or fax to avoid an office visit. This year's tax return, payment, and extension filing deadline have all been pushed to July 15th. You have plenty of time to get us your tax documents, but please don't procrastinate. We don't want to file an extension for you if we don't have to. So what about required minimum distributions, RMDs? RMD rules have changed. Mandatory IRA withdrawals now begin at age 72, not age 70 and a half as it was previously. If you won't turn 72 until after this year, you won't need to begin RMDs until you do. The current stimulus bill before Congress may cancel RMDs for this year. We will be sending out our required minimum distribution reminder in about 90 days, and if RMDs are canceled for the year, we will let you know. How are we handling office visits? We have transitioned all client meetings to telephone, Skype, FaceTime, and video cell calls. Email is always an option for communication, but we cannot text. FINRA prohibits our use of instant messaging systems. Given the average age of our clients, we're asking you to avoid the office as much as possible. Of course, coming in to sign paperwork, drop off your tax documents, or a check is always no problem. Back to you, Noel.
All right. Well, thank you, Jeff. Well, that's all we have for you today. Thank you very much for listening to this message. We hope it's been useful. We hope the information has been helpful. We're here for you. We're here to take care of your needs. Please call us. Please email us. We can do messages. We can do meetings over the internet or over the telephone. There are lots of ways that we can continue to serve you. We're here for you. We are praying for you. We want you to be at peace during this time. We want you to be healthy. Those are our main concerns for you. And if there's anything that we can do to help you, to serve you, please reach out. In the meantime, we'll be in touch with you. God bless. Take care. Thank you.